Hi, this is Jared Snider with Exencial Wealth Advisors, and we're here in week 3 of our series geared towards energy executives, specifically those executives that are contemplating early retirement or retirement, taking some sort of separation package from your company, maybe moving to another company or another role, or perhaps just leaving the industry entirely. If that's you, this video series is really geared for you. And in this week, we're talking about your investment allocation. Well, what do we even mean by investment allocation? All allocation really is talking about is your mix of different asset classifications. So we tend to break those down into one of 3 buckets. There's a lot of complexity that can exist around your investments. Where does it really fit? What function does it really have? And so we think if we categorize them in one of these 3 buckets and we really give them a job, then it helps to provide clarity and simplification around your investments. So those 3 buckets, those 3 categories, if you will. The first one is preservation assets. So those are assets that are meant to preserve the nominal value of your investment, and they would be represented by things like cash or fixed income. The second bucket would be inflation hedging assets. And those are assets that are meant to do just that, hedge rising inflation over time. Examples might be REITs, real estate investment trusts, infrastructure companies, commodity exposure, maybe some higher yielding equity. And then the third bucket would be a growth bucket. And so that would just be exposure in publicly traded stocks, both in the United States and outside the United States, large cap, mid cap, and small cap. There are some complementary assets that I think we can talk about on a future video, but those are the main focus, those 3 asset classifications and those assets I described. Well, that's what we'll focus in on today. So those assets, whenever we look at them and we look at them in your existing portfolio, your current portfolio, that portfolio will have an expected return. And whenever we think about the expected return on your investments, I would really focus on total return. Total return just means capital appreciation plus whatever income those investments are producing. So in the case of a stock, that's the growth of the value, the price value of the stock over time, plus whatever dividend that stock is producing. That's your total return. Total return is really important because whenever we look at your overall portfolio, the total return of your growth assets, the return that we'll have on inflation hedging assets and preservation assets together, blended together, that gives you your future expected return on your portfolio. It's important because it has direct bearing on your financial outcome both now and in the future. Last week we were talking about your cash flows, and one of the sources of your cash inflows is actually your investment portfolio, right? So we have cash that's coming in both now and in the future, and there will be a point in the future whenever we actually may need to rely on our cash flows as a source of income. So your investment portfolio really needs to be positioned to accomplish your goals around growth, growing our assets, preserving our assets over time, making sure that we're hedged against all the risks that are out there in the marketplace, and then positioned to produce the cash that we need. And so if you just think about a little example, think of someone who is at some point in the future going to need liquidity from their portfolio, maybe today, maybe in 10 years. But let's say their withdrawal rate is about 3%. They need about 3% of their investments withdrawn on an annual basis to cover living expenses as part of their cash flow plan. Well, certainly their investments need to cover that 3% withdrawal rate. But in addition to that, we also have to account for inflation. So let's just assume for a minute that inflation is going to be 2%, say over the next 5, 7, 10 years. If we're withdrawing 3% on one hand and we have inflation of 2% on the other hand, that means that the productivity of that person's assets going forward needs to at least be 5%. So whenever you look at your current portfolio and you calculate an expected return on that portfolio, if you're less than 5%, that tells you need to increase the future expected return by repositioning your investments. Let's say you may, on the other hand, have a much higher expected return for your portfolio. If you're a long ways away from that liquidity need from your portfolio, maybe that makes sense. But ultimately, we want to make sure, and I would suggest that you make sure that whenever you reach a point that you need liquidity from your investments, that you have enough growth to cover those withdrawal needs and to hedge against inflation, but that you also have some safety, some stability really built into your portfolio with preservation assets. So next week, we'll continue this conversation around asset allocation. We'll dive into a little bit more detail, maybe put a little bit more meat on the bones there for you. But I hope you have a great week, and if there's anything that we can do to help you think through your allocation, maybe you're evaluating it right now and you're not really sure if your allocation is positioned the way it needs to be based on your goals and based on your your need for liquidity or whatever is going on in your world and universe, we'd be happy to be a sounding board for you, help you take a look at that, be a second set of eyes. Please feel free to reach out and anytime, and we're glad to help. Thanks. Have a great week.